Singapore's largest retail and commercial REIT, CapitaLand Integrated Commercial Trust, or CICT, stand at the heart of Orchard Road, Raffles Place, and beyond. With a portfolio of iconic malls, Grade A offices, and integrated developments, CICT is more than just a landlord. It's a gateway to the future of urban real estate. But in today's high-interest, high-risk environment, does CICT still offer investors stable income and long-term upside, or has its growth story slowed down? In this video, we'll break down 6 financial performance, portfolio strength, valuation metrics, and analyst sentiment, and help you decide whether this REIT deserves a place in your portfolio. Quick disclaimer, this video is for educational purposes only and not financial advice. Please do your own due diligence or speak to a licensed advisor before investing. As of 2024, CICT's portfolio is well diversified across 3 core business segments. Retail properties make up the largest share at 44%, including iconic malls like Plaza Singapura and Bugis Junction. Office assets contribute 34%, with premium spaces such as Capita Green and Asia Square Tower 2. The remaining 22% comes from integrated developments, combining retail, office, and hospitality, like Raffles City, Singapore. On the geographic front, CICT remains firmly anchored in Singapore, which accounts for 91% of its asset base. However, the trust is also expanding its footprint overseas, with 5% of assets in Germany and 4% in Australia, focusing on stable, income-generating commercial hubs in cities like Frankfurt, Sydney, and Brisbane. This dual-pronged strategy ensures that CICT benefits from Singapore's urban strength while tapping into growth opportunities abroad. Let's take a look at the asset breakdown of CapitaLand Integrated Commercial Trust across its key markets in 2024. Starting with Singapore, CICT's home market, Singapore, accounts for the lion's share portfolio, with 15 major properties totaling an estimated 14.4 billion Singapore dollars in asset value. The crown jewel is Raffles City, valued at around 2 billion Singapore dollars, followed by Capita Green at 1.4 billion Singapore dollars, and Plaza Singapura at 1.3 billion Singapore dollars. Other major contributors include Asia Square Tower 2 and Bugis Junction, each worth over 1.1 billion Singapore dollars, along with Capital Tower, 6 Battery Road, and Tampines Mall, forming a robust mix of retail and Grade A office assets. This strong Singapore base ensures steady income and capital stability for unitholders. Moving to Germany, CICT owns 3 key commercial properties in Frankfurt, collectively valued at around 1.25 billion Singapore dollars. Galileo leads with an estimated 560 million Singapore dollars, followed by Main Airport Center at 440 million Singapore dollars, and Skyline Plaza at 250 million Singapore dollars. These strategic acquisitions provide euro-denominated income and diversification in one of Europe's top financial cities. In Australia, CICT owns a single asset, 101 Miller Street and Greenwood Plaza in North Sydney. Valued at approximately 430 million Singapore dollars, this integrated development contributes both office and retail revenue in a prime business district. Altogether, this diversified portfolio across Singapore, Germany, and Australia helps CICT balance stability with selective overseas growth, offering resilience, rental income visibility, and long-term capital appreciation. CICT dominates the Singapore REIT landscape with commanding 25% market share, underpinned by its strong presence in retail and Grade A office properties. It stays ahead of close competitors like Mapletree Commercial Trust at 18% and Keppel REIT at 15%. Despite growing competition from players like Lendlease Global REIT and others, CICT remains the market leader in its home turf. In Germany, CICT plays a niche but strategic role, holding 2% of the Frankfurt office market, while local heavyweights like Deca Immobilien and Allianz Real Estate control 30% and 25% respectively. CICT's presence in Frankfurt provides valuable international exposure and diversification. In Australia, CICT holds a small 1% share in the commercial property market, anchored by its investment in a Sydney asset. Dominated by giants like Dexus and GPT Group, CICT's presence may be minor, but it represents a deliberate move to broaden its geographic footprint. Together, These charts illustrate CICT's market leadership in Singapore and its strategic footholds in key overseas markets like Germany and Australia, balancing dominance at home with diversification abroad. Let's break down the latest financial performance of CapitaLand Integrated Commercial Trust, or CICT, across 3 years, from FI 2023 to the trailing 12 months of FI 2025. Starting with revenue, CICT brought in 1.586 billion Singapore dollars in the latest TTM, a modest increase of 1.7% from the year before, reflecting stable rental income from its diversified portfolio. Net profit came in at approximately 933.7 million Singapore dollars, an 8.3% jump compared to FI 2023. This improvement stems from tighter cost control and a slight uplift in tenant sales recovery across retail assets. Moving to EBITDA, it remained largely stable at 1.049 billion Singapore dollars, down just 0.3% year-on-year. This indicates consistent operating efficiency despite macroeconomic headwinds. CICT's operating and net profit margins both held strong at approximately 66% and 59%, respectively, a sign of resilient core property performance. However, free cash flow dropped to 865 million Singapore dollars, a 10% decline, primarily due to increased capital expenditures for property enhancements and ongoing asset rejuvenation efforts. On the debt front, net debt to equity and debt to equity ratio remained unchanged at around 58%, well below the regulatory ceiling. This shows CICT continues to maintain a prudent capital structure. In terms of earnings per unit, it stayed stable at around 13 cents per share. Meanwhile, the share price hovered at 2 Singapore dollars and 19 cents as of August 2025, suggesting the market views CICT as a stable dividend play. Lastly, liquidity remains strong, with daily trading volumes averaging over 20 million units, giving investors confidence in entry and exit flexibility. Overall, CICT's TTM financials reflect a REIT that is steady, stable, and well-positioned to navigate interest rate and market uncertainties, while continuing to deliver consistent income to unitholders. Let's take a closer look at CapitaLand Integrated Commercial Trust's core financial performance from 2021 to 2024. Starting with net property income, or NPI. This is the profit CICT earns after deducting property-related expenses. It grew steadily from 951.1 million Singapore dollars in 2021 to 1.15 billion Singapore dollars in 2024, showing solid income resilience even amid economic fluctuations. Next, we have gross revenue, which covers total income from rent, parking, and other sources. It climbed from 1.31 billion Singapore dollars in 2021 to 1.59 billion Singapore dollars in 2023, before reaching 1.59 billion Singapore dollars again in 2024, a modest 1.7% increase from the previous year, indicating a stabilizing revenue base. Moving to distributable income, the amount available for unit holders, CICT distributed 674.7 million Singapore dollars in 2021, rising to 752.2 million Singapore dollars in 2024, reflecting strong cash flows and stable occupancy. On a per unit basis, the distribution per unit grew from 10.40 cents in 2021 to 10.88 cents in 2024. While the growth is incremental, it highlights CICT's consistent and reliable dividend track record. However, it's worth noting the payout ratio declined from 70.94% in 2021 to just over 65% in 2024. This suggests CICT is holding back more income for reinvestment or debt management, while still delivering healthy returns to investors. In terms of revenue growth, 2022 marked the strongest year, with a 10.5% jump, driven by post-pandemic recovery. Growth tapered to 8.2% in 2023 and slowed further to 1.7% in 2024, signaling a more mature and stabilized income stream. Looking at operational efficiency, the NPI margin has remained robust, hovering around 72% over the years. This shows that for every dollar earned, CICT retains a significant portion after covering operating costs. Finally, the operating expense ratio, which reflects cost management, remained relatively stable, ranging between 27% to 28%. In 2024, the ratio improved slightly to 27.3%, reinforcing CICT's discipline in maintaining cost efficiency. Let's now explore the valuation metrics of CapitaLand Integrated Commercial Trust, or CICT. Over the past 4 years, starting with the price-to-book ratio, we saw a premium valuation in 2021 at approximately 1.09 times NAV. But since then, it has gradually declined, hitting 0.999 in 2022, dropping further to 0.888 in 2023, and recovering slightly to 0.905 in 2024. This indicates CICT was trading at a discount to its net asset value for the last 3 years, potentially signaling undervaluation or investor caution. Speaking of net asset value per unit, it remained stable at around 2 Singapore dollars and 6 cents from 2021 to 2023, before rising to 2 Singapore dollars and 13 cents in 2024, a modest gain supported by higher asset values and prudent capital management. Now looking at dividend yield, CICT offered a yield of about 5.25% in 2021. It dipped significantly to just 2.5% in 2022, likely due to price movements and payout adjustments, before rebounding to 4.76% in 2023 and a strong 5.82% in 2024, making an attractive income-generating REIT. Overall, the trend shows CICT is maintaining a solid NAV base while offering increasingly attractive yields, even as its market valuation trades at a discount. This combination of income and potential capital upside could appeal to value-focused and income-oriented investors alike. Again, let's take a closer look at the income performance of CapitaLand Integrated Commercial Trust, or CICT, from 2021 to 2024. Starting with funds from operations, or FFO, one of the most critical measures of an REIT's recurring profitability. In 2021, CICT generated 865.6 million Singapore dollars in FFO. That figure grew steadily year on year, reaching 931.6 million Singapore dollars in 2023. However, by the trailing 12 months of 2024, FFO moderated to around 691.5 million Singapore dollars, reflecting a softer macroeconomic environment and potential asset rebalancing. This data is based on semi-annual financial releases and third-party finance portals. Next, let's talk about interest coverage ratio, a gauge of how well the REIT can cover its debt interest using its operating income. In 2021, CICT maintained a strong coverage ratio of 4.1 times, which gradually tapered down to 3.6 times by 2023. As of mid-2024, the ratio dipped slightly to around 3.1 times, but still remains above safe levels, indicating a prudent capital structure and strong liquidity management. In summary, despite some softening in FFO and interest coverage in the latest year, CICT continues to demonstrate solid fundamentals and disciplined debt servicing capacity, key strength for investors seeking stable and resilient REIT exposure. CICT's 2024 property operations reflect exceptional portfolio strength and tenant retention. Flagship retail malls like Plaza Singapura, Tampines Mall, Badak Mall, and Junction 8 are all operating near or at full occupancy, a testament to their resilience and prime locations. In the office segment, Capita Spring, Raffles City Singapore, and 21 Collier Quay all report near-perfect occupancy, maintaining CICT's competitive edge in the CBD landscape. Even Clark Quay, which was undergoing repositioning, has recovered to 97.1%. Internationally, CICT's assets shine too. Both Galileo in Germany and the Sydney office building in Australia report 100% occupancy, showcasing CICT's successful overseas expansion. Overall, CICT's operational portfolio remains highly utilized, diversified, and well-leased across retail, office, and mixed-use assets. Let's take a look at CICT's lease profile and rental trends for 2024. Starting with WALE, or weighted average lease expiry, a key metric that reflects income stability and tenant retention. The retail portfolio has a WALE of 2.2 years, which is typical for retail leases, and provides flexibility to capture rental upside in the short term. The office portfolio shows a longer WALE of 3.5 years, indicating strong tenant stickiness and income visibility, especially critical in competitive CBD office market. For integrated developments, the WALE stands at approximately 2.6 years, balancing both retail and office exposure. This lease profile suggests that while CICT maintains short to mid-term lease flexibility, it also secures stable cash flows from its longer tenure office assets. Now let's talk about rental reversion, which measures how much higher or lower the new leases are compared to expiring ones. CICT achieved positive rental reversions across key segments in 2024. Retail saw moderate upward reversion, reflecting recovering tenant confidence and shopper traffic. Office assets in prime locations like Raffles City and Capitol Tower also registered slight rental growth, despite macro headwinds. Integrated developments, blending both office and retail, posted stable to slightly positive reversions, further supporting DPU growth. In summary, CICT's portfolio continues to show a healthy balance between short-term upside and long-term resilience, driven by proactive lease management and strong asset positioning. Let's take a closer look at CapitaLand Integrated Commercial Trust debt and leverage profile from 2021 to 2024. Starting with the gearing ratio, CICT has managed its leverage prudently. It stood at 34.2% in 2021, then rose temporarily to around 40.6% mid-2022, before stabilizing at 39.9% by end 2023 and 39.8% by mid-2024, well below the 50% regulatory cap for Singapore REITs. In terms of cost of debt, the average interest rate climbed from 2.3% in 2021 to 3.4% in 2023, and further to 3.5% in mid-2024. This upward trend reflects a tightening global interest rate environment, but CICT has proactively locked in favorable rates earlier. Looking at the fixed versus floating mix, around 78% of borrowings were fixed rate in 2022 and 2023, providing income stability. This dipped slightly to 76% in 2024, still reflecting a conservative risk approach to interest rate volatility. Lastly, CICT's debt maturity profile is well spread. The average term to maturity in 2023 was 3.9 years, and only 13 to 15% of debt is due in 2025 and 2026, with the rest maturing in later years. This staggered schedule significantly reduces refinancing pressure. In summary, CICT's capital management demonstrates resilience, balancing growth with stability, while keeping financial risks under control in a rising rate environment. Let's now explore the key opportunities and risks facing CapitaLand Integrated Commercial Trust, or CICT. On the opportunity side, CICT stands to benefit from the recovery in office and retail demand as footfall rebounds in both CBD and suburban locations. Many of its flagship malls and offices are experiencing positive rental reversions, which should support revenue and NPI growth. CICT also has room to grow through asset enhancement initiatives, unlocking value from existing assets while benefiting from Singapore's REIT-friendly regulatory environment. Its prime locations and diversified portfolio also make a natural choice for investors seeking stable, income-generating properties. But on the risk front, CICT isn't immune to macroeconomic pressures. Rising interest rates are increasing its cost of debt, which could impact distributions. The REIT also faces currency risk from its properties in Germany and Australia, and short whales on some retail assets may introduce income volatility. Lastly, while its gear remains within regulatory limits, this cap could constrain more aggressive acquisitions if not carefully managed. Overall, CICT presents a well-balanced mix of resilience and challenges, making a key REIT to watch in Singapore's real estate landscape. CICT is Singapore's largest REIT, with a resilient, diversified portfolio across retail and office spaces in Singapore, Germany, and Australia. It offers stable distributions, high occupancy, and prudent debt management, even amid rising rates. For investors seeking reliable income and blue-chip REIT exposure, CICT is a strong long-term core holding. Like this video if you found it helpful. Subscribe for more sharp insights from Durian Finance.